Record. Hi, all. Welcome to a new episode of Free Float. This week, we are discussing how to sell. So, usually, usually, almost like 99% of investment literature is about um, shortlisting stocks, buy and hold forever, or buy and die, as some people say. And basically keep the stock no matter what, come heaven or hell. But obviously, as a quant, I differ. I prefer to exit a stock, if it's just not working out. And we are talking about portfolio level decisions, not life decisions. This is not a personal finance take. This is more about at a portfolio level, when should you exit a particular position. So Kishan, do you want to give a brief intro on this?
Yeah. So, like you said, right? There are a lot of topics about, when do you buy a stock? All kinds of stuff. About, you buy it below its intrinsic value, or you buy it. Um, you track a company and then you buy it when it's fallen, like from its from like its highs of like 20%, or you buy it when its earnings are increasing. There are plenty of literature, but I'm sure you've seen this. Where somebody say that if you bought Amazon in '95, of 1,000, and then if you just held it till now, it was worth so much more. And I've always thought, not just me, but when I first pointed out this to someone, they told me, imagine the number of times in that intervening period that you would have wanted to sell. That that the urge to sell would have been so much in between that it's all easy in hindsight. But say you bought some company and it doubled in, say, in today's market, it will double in a week. So if it doubled, what would be the urge for you to sell it rather than just keep it and think in 10 years from now it would have gone up 10 times, what you paid for it. How many times would you have wanted to sell it in between, thinking that you'd go read some news story and then, oh my god.
This financial news is the worst, because there was a time when I used to aggregate all news items, so do some NLP on it and figure out which tickers, what are the company names within the text, and map it to different tickers and allow clients to read. So what I realized is that's one surefire way of increasing your brokerage revenues, because people will read that and freak out. It doesn't matter whether it is good news or bad news. That the minute they see that headline, it's a call to action, whether it's to buy more or to sell more or to so whatever. So it's completely damaging to your portfolio if you somehow get hooked on to this sort of nonsense financial news. Yeah, continue.
Yeah, and so so the question becomes then, when you sell a position, because it seems to be, there's a world of of timing in it, and the timing is is prone to errors, the decision to sell is is prone to many errors, both behaviorally, and you can make errors by taking the wrong advice, or not having a right idea of uh, why you're selling a particular position. You might be selling it for the wrong reason. So I think the when to sell is far more trickier than when to buy. And
I don't know. See, I think it's not that tricky, right? when to sell is the inverse of
So you're
when to buy.
so you're a systems guy, being a system guy, you know, what we tend to do is, we backtest something. So, based on, and these parameters are, all about when you exit a stock and when you enter a stock, right? And so you exit a stock based on based on what target there is, and of where the stop loss is. So both those things are well defined, and the hard part of following a system is following the system consistently. Like you might have a system where where you enter a stock. Like for example, our all-star portfolio. You enter a stock when the stock uh, is crosses all-time high, and that is so counterintuitive to many people that when a stock is hit its all-time high is when most people think, oh my god, I missed out on this big rally. Now the stock is not going to go. I mean, the rally is there, so why will I go buy the stock? That's so counterintuitive to anyone that because most people are trying to ride the stock to its all-time high. Like they want to catch the bottom and ride the stock to its all-time high, and so the hard thing about following any system is, actually following the system consistently. So for us, the decision to sell, or when to buy is much more easier because it's defined by rules. The hard part is actually implementing the system. But as long as you do it, um, the system will either work or will not work. But that's a different story. But I think in a more larger context, you have the loss aversion bias. You have people trying to a lot of people sell their winners and hold on to the losers. So the ones which is which seems rational to them because oh my god, I have stocks that I've lost money in, and those stocks will come back and then sell them at least at break even, and I'll sell my losers, I mean my winners now because they're making money. So imagine if they fall, it will. I mean, then I will have, and then I lose whatever I invested. So people, a lot of people do it just extremely flawed. The one of the things I've learned is you should always keep your winners and sell your losers, which is and it's most ideal to ride your winners up to the end. So if you have no reason to sell a stock, you shouldn't sell it. Like if it's completely discretionary, then you should not sell the stock. Unless you need the money or you need it for something else.
Yeah,
But
I don't
but
know
that's
because see
very, very subjective.
yeah, so the problem is this, right? So you mentioned Amazon. There are stories about similar stories about Coca-Cola and Pepsi stocks as well. And the worst thing is, Coca-Cola stock, right? So they had a fairly decent franchise. They invented Santa Claus and everything. So they had like a huge moat. And in between, they somehow convinced themselves that they needed to own a movie studio, and they went and bought Paramount Pictures. So if you were a value investor, you would have kind of got disgusted with it and you would have dumped that stock. Um, but there are people who just forgot that they had actually owned that Coca-Cola stock, and they've become the millionaire next door, so to speak. They just outlasted the whole um, cycle of both them trying to diversify and then trying to get rid of those extraneous stuff. So it's always a tricky thing in a discretionary environment, because something that you buy because you think is good value, right? um, and what happens is, you're not the only one right now doing it. I think in a recent interview, who's the guy who keeps saying nobody knows anything, so that chap, he finally admitted that if you're trying to do value investing by looking at the same financials and the same data that everybody else is doing, then I don't see what the edge is, right?
Yeah.
So everybody knows, what the cheap stocks are. Everybody knows what the story is. Everybody knows what the growth stocks are. So we no longer live in the 70s or or the early 80s when you basically had to scan, the Wall Street Journal or something like that to figure out, what is what. You can just
Yeah.
go to screener.in and run the screener yourself. So the question is, if you're acting on the same data that everybody else is acting on, then how are you going to differentiate yourself, and how are you going to be different from the rest of the pack? And
Well,
right.
I think I think I think the most important thing is that let's assume that you have some strategy, right? Like even if you're a discretionary investor, you have a particular investment philosophy, and you are generally looking for particular kind of stocks. Say you're looking for stocks which are growing at a very high, at a high growth level. So where sales are growing at say plus 20%. Year on year. I mean, the company has some blockbuster product, or it's a leader in an industry which is fast growing. So you would have in today's environment, you have SaaS company and stuff, and that's your investment philosophy, uh, and that's your focus, and you have perhaps a better insight into that industry, because you're maybe you speak to people from the industry, or you're working in the industry, and or you perhaps just read more than most people do, and you understand the industry somewhat, uh, and so, but it's a completely discretionary. So I pick companies based on how they're performing, and I allocate based on my preference to the companies I like in that sector. uh, so if I was doing that, I would my sell my sell point perhaps would be, if it's entirely based on growth, it would be when that growth slows down. Then I would be like, okay, this the multiples of this company would get revised. And then the ideal thing for me is then to exit the stock, and even if the stock goes up from there, in multiple hundred percentages, I should still not look back and say regret it, because at the end of the day, I achieved what my objective was. My objective was to invest in highly growing companies in this particular sector, and I achieved my objective. And when I observed that that growth had stalled, I believe that the stock would not appreciate as much as it did, and I moved on from that to something else. I think a lot of it is to do with why you invested in a particular stock or in a particular strategy, and that becomes very hard to very important. So, for example, even if you're following a system, you know, like a quant strategy, uh, don't you think that even there the exit is not really exiting a particular position, but it's exiting the strategy? Like we know, many strategies have a shelf life, right? So, like
So the thing is, see, shelf life apart, right? So within, say, a portfolio, say you buy something because you feel it's undervalued, then it is trading at a lower price because investors as a whole have a different opinion and a different timeline compared to you. So say that stock take, you expect the stock to take at least 1 or 2 years before it starts recovering, right? So you buy the stock and you sit on it. So there's obviously a sort of opportunity cost that, during that time you're not making any, you're just waiting. Now what happens is, say, the management starts delivering, and and other people recognize, and they start ramping up the stock. Now suddenly, it's no longer a value stock, right? It has transitioned into a value in motion, or God forbid, a growth stock. Because I recently heard that Pidilite invested in Pepperfry, right? So obviously, they work, they are in a sort of saturated market where what comes after Fevicol and Araldite, nobody knows, right? They already have the majority market share in all those places, so they can't really grow faster than the market for Fevicol and Araldite as a company. So now they're gone and invested in Pidilite. So suddenly you got this quality. I mean, they went and invested in some .com furniture company. Now, so if this is the beginning of a series of such investments, then what you're seeing is a so-called quality company transitioning into some sort of a late stage VC listed firm, right? Something like what InfoEdge is doing, right? So they took the cash flows from Naukri.com and went and invested it into a bunch of startups. So you've gone from a stable quality cash flowing company into a growth company. Now, are you a growth investor? Do you really understand what is going on in that company? No, because you're a value investor, right? It's not your job to bet on that. So supposing you go and sell those companies, right? The market has its own idea of how great those things are, and they will start ramping that stock up because the market loves a good story, right? And you're going to see the stock that you sold, because it's no longer value, go up 3x or 4x or 5x in in a jiffy. So it's very difficult to sort of say exit when your thesis no longer holds, because what happens is the same stock transitions. So it's what begins as value becomes value in motion. It might become growth, and then it might become a momentum play. So if you say that I'll only invest within this value band, then you're missing out on a whole bunch of appreciation that happens just just by increasing multiples, not really increasing EPS or whatever, increasing intrinsic value. So it's a difficult thing to say I'll only invest in this segment, um,
Yes.
so that's why I feel you can have a fundamental reason to buy a stock, but exiting it should be technical. So you know uh, and in a sense, if you incorporate some sort of technicals into your buying decision as well, you'll probably do better. So don't buy a value stock that is just going down, right? So wait for some sort of stability, some sort of technical thing to happen there.
Yeah. But then, so in the recent Howard Marks memo, right? I'm not sure if you read them or anything. So um, Howard Marks is speaking to his son-in-law, and
Yeah.
they made some recent, some investments in some tech names and and some stock, right? And he comes from the private equity world. And so Howard Marks, so they made a decent amount of money in the last year, in the past year or so. And so Howard Marks, being a typical, old Wall Street guy and an old investment, framework, asked son-in-law whether you should, exit, whether they should take some money off the table because they made, money. And so the son-in-law, and that actually got me thinking about, this week's piece, that uh, the son-in-law told me that, it's very hard to find companies like the ones that they've invested in. So I would assume it's a lot of the top tech names and so. And the idea is that these companies are growing, and they're growing. Even now, the FANG universe is growing at 20%. At revenues, and they have got considerable advantages and moats. And maybe 20 years from now, those moats might not be as important as they're today. But uh, at least in the foreseeable future, they will tend to dominate. So the idea is, why would you want to sell I mean, not that these companies cannot fall 30-40%, but the idea is that you don't. I mean, like you said, technicals can give you that that thing of exit, but it's a very most technicals are short term in their thing, right? I mean, they might give you a sell signal, and the stock might fall 20-30% from there, but you might not be able to find a better investment than these stocks, if you have a longer investment horizon.
Well, if you have a longer investment horizon, you still need to worry about what your returns are
But
going to be and the alpha decay inward, right? So let's say you
yeah,
you bought a great stock. The market also believes it's a great stock. So year one, it went up 20%. So great. Everybody's happy.
so
Now, what happens in year two, right? So everybody
yeah,
knows it's a great stock. Now. Uh, some amount of growth is already factored in. Now they
yeah,
have to actually beat those expectations to for your price to actually go up. So if you're not not being able to find another viable candidate is a bullshit reason to stay in a stock beyond its life, right?
yeah.
So
So
you exit and then you figure out what you're going to do with the money. Keep it in treasuries if you can't find. Look at what Warren Buffett is doing, right? He's sitting on a cash pile. He doesn't know what to do with it. There's just no uh, you know good companies to invest in, so
yeah,
just wait.
yeah. So I think that's partly it. I mean, I think the first thing to do is sell your duds.
Yeah.
Sell the companies that are not. I mean, are not going the way you wanted to. Both from a financial point of view and a stock point of view. The question is, what happens to the companies that are doing well? Now, I think even you say that a company that is going in double digits, which is doing well, and you believe the company is in the right path. Valuation is not a reason for to sell. I mean, is to sell a stock. I just right now it doesn't seem that. I mean, the reason to sell a stock, would it?
Yeah, so
Or just
it's
on
more
up?
than valuations. It's based on expectations, man. So say company says Infosys, for example, right? They will say, okay, I'm going to grow revenues by 10% in dollar terms. Just giving an example. Now that expectation is already set in the price the minute those words are uttered, right? Now for the company's price to appreciate beyond that level, right? What the market is then saying is we expect it to be like 12% or 15%. Basically I expect the actual growth at the end of next year to be way more than what the management has projected. Now that's the only reason why the stock price is going to go up. Now if you're a holder of Infosys and you bought it before the management set those expectations, and say maybe the growth before that was 5% a year. Now once the management came and said double the target, the price would have spiked, right? Now your job is not to sit there and do DCF valuation. Your job at that point is to estimate whether next year the growth is going to be more than what the management said it's going to be or less, right? So it's all expectations investing at some level. And if it is not, and if you think it is not going to happen, you need to exit that stock irrespective of whether you have a viable candidate lined up or not, because you may not get that opportunity to exit again.
But my investment mandate might be that I invest only in large cap, high quality, stocks, you, and and so my mandate might just require me to be in a stock like Infosys, believing that these companies will not just grow their earnings, but given that in India there are many companies which are I wouldn't say low quality, but I mean the very few companies that come from a market perception that comes to the quality of Infosys in terms of its management. I'm not just betting on the growth in the company. I'm betting that the demand for a company like Infosys will be so much by investors that that the multiples will also expand quite a bit, and that its stability in its earnings, and the dividend yield, and all those things would not just drive like investors from India, but it'll also get investors from abroad who are attracted by these things. So my mandate would be to stick to a company, to Infosys, high and low, and if you see Infosys, in the last 20 years, year on year, it's. I mean, the stock has done pretty well. I think it's some 10 or 11%.
Right. So my point is basically that yeah, you have to figure out what sort of expectations are embedded in the price, right? And see if it is valid, if it's going to hold, going forward into the future or not. So if that's your job as an investor. And the minute you feel that some of your assumptions are no longer going to be held true, that's when you quit. I mean, that's when you quit the stock. And in the case of Infosys, all that you said, right, it's all kind of baked into the current price. And the only thing that matters to the price going up or down is the change, it's the delta. It's not the actual absolute level of things. So the delta being that will flows into India increase, right? It's not the absolute level of flow. So if say $10 billion flowed into India last year, and $10 billion is going to flow into India this year, there is no increase in that, right? So that itself matters less than that 10 billion becoming 12 billion, right? So you have to always look at that incremental flows, the not just the velocity, but also the acceleration of things. So I'm just giving you the example of flows, but the same thing applies to growth as well, right? So it is not enough that you grow at 10% every year. You have to basically surprise the market with a 12% growth for you know for kind of pushing your stock higher, right? So if you don't think that that is going to happen, and that management is going to stick, if management says 10% and it's going to be 10%, then that is already reflecting in today's price. So if you invested based on that, then it's probably time to reconsider your thesis on that stock. So so the thing is, say Warren Buffett's investment in Apple, right? It happened at a time when they realized that Apple is moving towards a marketplace rather than
Yeah.
just selling devices, right? So right now, if you see, which other company is making this transition, it's Nintendo, right? So
Yeah.
for the longest time, they were just selling devices, and they were making games themselves. But now they're moving into a platform play. So these are the kind of things that investors will be looking at, and if that is your thesis, right? So you need to kind of always be on top of it, saying, is that thesis still valid? And minute it stops being valid, you exit. So there is no so it's always good to kind of write down why you entered a stock if you're doing discretionary investment. So just a paragraph as to why you entered a stock, that will help you
Yes.
kind of decide whether it's time to exit that stock. So all those reasons you give for entering, they're no longer valid at any given point of time. That's when you exit, and you should be at peace with your decision, because the market might push the stock high or down or low. I know market can do weird things, that's out of your control. So it's always best to write stuff down when you initially buy the stock. And this is where I think, as systematic investors, we may not actually experience the highs and lows that a discretionary investor experiences, but at least all our stuff is coded in programs and computer code. So your the reason for buying and the reason for selling is already predetermined. So in a sense that we may not capture 100% of the move, but we capture the move that matters the most.
Right.
Right.
Interesting.
Yeah. So anyway, so this is, we can keep talking, go on talking about this for ages, right? Because when to sell is just as important as when to buy. And unfortunately, most discretionary investors focus too much on when to buy and not on when to sell. So, and I think selling is also equally important, and investors should pay attention to it. And the best way to do it is write down your buy thesis, and the minute it's invalidated, you sell. So I guess this is a good point to sort of jump off. And I hope our subscribers enjoy what you've written about that. Thanks once again.
Right. Thanks.